afternoon. We're back at IMF headquarters for the World Bank IMF spring meetings in 2025. Today the dollar is down, stock markets are down, bond markets are down. The reason is that there were some remarks about the Fed governor by the White House, and it's been a trend the last couple of weeks that investors have doubt about the attractiveness of the US financial markets, and we see it in the markets every day. So our topic today couldn't be more up to date and interesting. We're talking about the sustainability of the US current account deficit. And to do that, we have two experts today. Joseph Gagnon from Peterson Institute. He used to be with the Federal Reserve and working on international finance and monetary policy. He's now at Peterson. And we have Tamim Bayoumi, now with King's College London, and a long career at the IMF, who was, among other products, responsible for the World Economic Outlook, and then had a long stint also at the US desk of the IMF. So the two of you have been working on a paper of that name, the sustainability of the current account deficit. It's going to be out at Peterson shortly. And let's kind of dive in right into the substance. First of all, maybe Joe, before we come to the sustainability, could you perhaps explain a little bit the difference between the trade deficit, which is what everybody's talking about, and the current account deficit, and why has the current account deficit been less in focus than the trade deficit lately?
Sure. Well, the trade deficit reflects a balance between exports and imports. Economists typically include both goods and services when they compute the trade deficit, although it should be noted that the Trump administration has focused specifically more on the goods part of the deficit. There's less, the justification for doing that is, well, I don't know if we want to get into that right now, but economists typically want to look at both goods and services because they're things that we sell and they support jobs. But the current account is a bit broader. It includes every thing that we pay to foreigners minus things that we receive from, or everything we receive from foreigners minus things we pay to foreigners. So it's a more broad concept that adds up to the total flow of assets, net flow of assets between the US and the rest of the world. And in particular, it includes earnings on assets that we have out there and payments we have on foreign holdings of US assets. It also includes unilateral transfers where Americans give money to foreigners for various reasons. So it's a broader concept. It's more relatable to the sustainability of the borrowing because it basically is the cumulative borrowing of the United States. But the trade deficit has a more direct impact on employment and economic growth, and I think that's probably why it gets more attention.
But is it right to say that the current account deficit has also been in deficit as long as the trade account has been in deficit, or have there been different trends?
The trends are very similar. The trade deficit has existed since the end of the 70s, 1980, and the current account deficit started up a little bit after that, and there's 1 year in which they deviated during the first Gulf War because there were some payments coming into the US from foreign countries. But basically, broadly speaking, the big movements in the current account balance parallel the movements in the goods and services balance.
Now, when we hear that a country has a big deficit, then at some point we think, well, there must be a large amount of debt being run up, and at some point this has to stop or being turned around because otherwise countries can't finance themselves anymore. But the US has been able to finance deficits for quite some time, and it also has run up a big negative net international investment position, as we call it, I think, at the IMF and among statisticians. Tam, why has the US been able to run up such big deficits over such a long time? What's different from other countries?
Well, as you say, the US has run a current account deficit and a trade deficit, so money has been flowing into the US from abroad for around 50 years, which is a very, very long term when you think about it, and quite substantial amounts over various times. And so in the end, the US has run up a debts of around 70% of GDP, which is, again, a big number. So how has it been able to do this without getting into the kind of trouble that countries often get into when they overborrow? Well, there are two basic reasons for this, which are both under the rubric called exorbitant privilege. An exorbitant privilege was a phrase made up by Giscard d'Estaing when he was the finance minister in France many, many years ago. And it relates to the ability of the US to borrow relatively cheaply from abroad. Now, there's two elements to exorbitant privilege which are often conflated but are actually distinct. The first is that the US offers safe assets. So if you want to invest something in the rest, if you're a foreigner, you want to invest in a safe asset, a lot of those safe assets are US treasuries or similar kinds of products. So they're in dollars, they're issued by the US government, and that's what you invest in. Because of all this latent demand for these products, the US is able to borrow cheaper than the rest of the world, which gives it a funding advantage, which is great. That means that the US can actually borrow at lower rates than it lends. The second reason is also related to the importance of the dollar in the US international monetary system. And that is that US markets are very big. So even as far back as the 2010s, US bonds basically made up 40% of world bond market, and US equities made up about 40% of the world equity market. Now, when you think the US economy represents in those days something like 20%, you can see that there's a massive mismatch. Now, if therefore somebody wants to hold a balanced portfolio in international bonds and equity, they hold a lot of US assets. So there's a natural inflow that comes into the US just from the sheer size of the markets, in addition to which, as I say, because they're regarded as safe assets, the US can actually fund these inflows cheaper.
And we're now kind of seeing, of course, some doubts about the reliability of US assets, right? US assets, as I said in the introduction. So there is this question of whether this can continue for longer. Now, your paper is looking into exactly that question. How much longer can it go? How sustainable is it? And Joe, how do you assess the sustainability of a country's current account deficits and international position, and what specifically do you need to think about when it comes to the US?
Sure. So and this is a big part of our paper. The key thing is that to be sustainable, over time, the ratio of assets and liabilities that we hold, so assets we hold abroad and liabilities that foreigners hold here, those values should not grow faster than our overall economy. They need to stabilize roughly as a share of GDP over time. Now, that doesn't mean that maybe we couldn't end up with even a bit more or maybe a bit less relative to our economy, but it can't keep growing forever. It has been growing over the past 50 years in waves, and we don't know where it will stop, but if we say, what we do is we say, well, where we are now is a good place to start the analysis. We have a very large negative liability position, net, and if that should stabilize, then we look at what needs to happen to make that come about. And some of the things that we do, which I think are important parts of the paper, is we actually look at how we measure both the value of the assets and liabilities, but also the rates of return on the assets and liabilities better than other people have, and even improve some of the data. There's some measurement issues in the data that we correct. We get, I don't know if you want to go into specific numbers or whatever, but we get that if we were to stabilize the net position where it is now, then we're going to need to have a correction of the trade deficit of anywhere from around 2 or 3%, maybe even a little more than 3%, but 2 to 3% of GDP. It depends on what you think that rates of return are going to be going forward to some extent, but that's the ballpark that we need. 2 to 3% of GDP. Our deficit is too large by about that much. That would require some depreciation of the dollar, 20 or 30% depreciation of the dollar in the long run to get that. I'm sorry if that's too much detail, but so now if we take another leg down, if there's further increase in those net liability positions, that's possible. It's going to need to stabilize somewhere. We can't go forever. And if it does keep getting larger, that's going to make the needed adjustment even larger because we're going to have to, we're going to be paying even more interest and profit returns on those liabilities that we're going to have to service somehow with a trade surplus. So, so in some sense, our calculations are conservative because they assume that the process stops here. But if it doesn't stop here, then the adjustment's going to have to be worse.
So, to think about it conceptually, for example, when we think about fiscal sustainability, right, then we have to look at the debt, we have to look at the government's deficit and the interest rate, roughly speaking. In the external sustainability, you were also talking about the return on assets, and so that would be the equivalent of the interest rate for a government that it has to pay. And I remember reading quite a lot over the years about the somehow superior return that the US received from how kind of its assets were invested abroad relative to what foreigners earned on assets here invested in the United States. I think you talk about that in your paper. Is that a myth, or is it also something that is consistently true, that the US achieves a higher return than foreigners here in the US?
It is consistently true, but we point out that it's somewhat overstated. There's two reasons why it's overstated. One is that both U.S. and we believe foreign multinational companies use accounting techniques that transfer profit into locations that have super low tax rates. And there's studies of this, and we rely on these studies to sort of estimate how big that is. We think it's about 1% of GDP. So so for example, when U.S. companies transfer profits into Ireland, then that elevates the reported rate of return on our investments in Ireland, and it reduces the rate of return in the United States. And the foreign companies have a similar incentive because the tax rate in the U.S. is higher, so the foreign companies also have an incentive to report their profits in Ireland. So we try to correct for this, to get at what really is the true economic rate of return on these investments. Even after doing these corrections, we find that there is a tendency for U.S. assets to earn more than U.S. liabilities. Oh, by the way, another piece of it is that we find that the way that the direct investment liabilities, the foreign investments in the U.S. are measured by the Bureau of Economic Analysis is, we think, not quite right. They have to make some assumption about the value of, say, BMW factories in South Carolina over time. Those aren't traded on the market, they're just a physical asset. And so what the Bureau of Economic Analysis does is it assumes that that goes up with the U.S. stock market. But the problem is that the U.S. stock market has been dominated by technology firms which are not the same as the companies that are actually doing the foreign investment. So it's Google and Apple that drive the U.S. stock market. BMW's price hasn't gone up with Google and Apple. So we make a correction for that too. And that makes the net position look less bad. But the bottom line is that once you make these corrections, you find that still the U.S. tends to earn more in its assets and liabilities, but by a more reasonable amount. And then the question becomes, how sustainable is that, and what would happen, we can get to this later if you want more, but what would happen if over time we were to lose some of that ability, which Tam referred to as the exorbitant privilege. The exorbitant privilege literally is this ability that we have to earn a bit more on our assets than our liabilities. That makes any net liability position more sustainable.
Yeah, Tam, so let's maybe talk about that. So just to recap, so you said that an adjustment of about 2 to 3% of GDP, right, in the trade balance, you said, and equivalent to about 20-30% devaluation of the US dollar.
Right.
So we're seeing some devaluation already, and improving the trade balance is a key target of the Trump administration, of course. Now, your calculations, are these calculations based on something, say, that precedes the Trump administration, or does it already kind of take into account some of the effects that we're seeing now, that foreign investors are already losing a little bit in confidence in the dollar? So how do these kind of concepts relate to each other?
Okay, well, as I said before, one of the great advantages that the US has is that it's able to borrow money at a lower rate than it lends out. The Trump administration, with the administration of tariffs, what's happened is something which is quite odd. It hasn't happened in the recent past, which is that normally when there's a shock to the world economy, take the 2008 financial crisis, right, which was made in the US, a bit like the tariffs. Despite the fact that it was US crisis, because the US is the safe asset, actually money flowed into the US and the dollar went up, and the value of treasuries went up, treasury bonds went up. What we're seeing now is the opposite. The US dollar is coming down, and the value of US treasuries is coming down, which means their yields go up the way that bond markets work. So what we're seeing is something where it does look, as you say, like foreigners, as opposed to previous shocks, where foreigners have said, oh, there's something weird going on, let's get into US treasuries. It seems like they're saying, oh, something weird's going on, let's get out of US treasuries, which is a very different story. Now, this means that you could end up with a lower trade balance because there's less money coming in, so the equivalent of that is there could be a lower trade balance. But if you remember, what I said was one of the great things about the US is that you can borrow at lower rates than you lend. Well, if foreigners stop wanting to hold US assets in the same way, then that funding advantage goes away, which means that the adjustment you need to get back to sustainability actually goes up. So to some extent, even though the trade balance may get better with these tariffs, it's not clear that the adjustment needed to get you to sustainability is better. It could even be worse in theory. It's difficult to tell because we don't know how much of that exorbitant privilege will go away, if any. And we don't know how large the adjustment in the trade balance is. But certainly it's not clear that adjusting the trade balance by eroding confidence in US markets is actually a useful way of solving the underlying problem, which is the sustainability of the US external position.
Yeah, in fact, the paper actually presents specific analysis that could put a number on what Tam just said, which is we look at each element of the so-called exorbitant privilege, and we assume it goes away. So we set, suppose that U.S. returns come in line with foreign returns on this asset, and then on that, and we show how each step of the loss of exorbitant privileges raises the adjustment needed for sustainability. And it's about 1 to 2% of GDP. If you lost exorbitant privilege entirely, that's a big number. So put that in context with well, maybe the falling dollar will reduce the trade deficit, but will it reduce it by more than that? You know, and you can decide for yourself. It's pretty shocking that you know it's a significant amount that we could lose in terms of the sustainability of the trade deficit.
So there's an element of chasing your own tail.
Yeah. Yes.
You never quite get there because the objective keeps on going further away.
Right. But maybe let's put it a little bit also in perspective. I mean, the US hasn't lost its exorbitant privilege yet, although there are some market tremors. But one could also say, for example, that people have already expected the US maybe to go into a mild recession or at least growth to slow down. So maybe some of the recent moves have simply accelerated that. And I mean, we don't want to be too pessimistic about things. But still, I mean, the dollar has now depreciated relatively quickly. It was like 108 for a long time, give and take a bit. It was stronger than now. It's at 115, I think, today to the euro. How do you think, Joe? You do a nice kind of also overview of recent of historic events. You have some review of the literature, and if you look at today's or this year's episode so far, how would you compare that to big swings in the dollar in the past? Is it remarkable? Is it something that you would say, well, you know, we've had those quite many times, nothing to worry about yet? How do you think the moves right now kind of compare to the past?
Well, I think if we go back over the whole history since this process started, but around 1980, the way I think of it is there have been three large waves of inflows into the U.S. and current account deficits, which grew and then partially shrank back, and they're each associated with dollar movements. So the dollar went way up in the early to mid 80s, and then came way back in the late 80s, and then there was another push up in around 2000 through 2003, and then there's a step down, gradual retrenchment around through the early 2010s. And now we're in a sort of third wave of that, where the dollar is very high. And as you say, in the past few weeks, we've seen some drop off of that dollar, but it remains at the high end of historical experience. So we should keep in mind that these swings are on the order of 30% in the dollar. And I think it's only fallen at, on average, 5%, maybe against the euro, maybe a bit more, but overall it hasn't fallen more than about 5%. So that could be the beginning of a correction back to where it was, but it's not historically large.
So when we talk about dollar dominance, what would be some kind of factors you would assess where you would say, well, you know, we should really be concerned about that exorbitant privilege, and you know, we need to kind of take some really serious policy action, like fiscal, like on the interest side. What are some kind of indicators that you would look out for when it comes to assessing the exorbitant privilege?
Well, I think one thing that we both agree on is the fiscal situation in the U.S. is not looking particularly sustainable, and it's certainly contributing to the worries about the dollar. It's hard to know how much is fiscal versus how much is the tariff war, but the fiscal part, I think, is one that's more clear what to do, because obviously if we keep, or not obviously, but studies show that as our debt grows as a share of our economy, as our fiscal debt, government debt grows as a share of our economy, that tends to raise interest rates over time. And that could erode the exorbitant privilege, because the exorbitant privilege is all about differences in interest rates. Our interest rates have been lower. That could go away. It's hard to know. I mean, the estimates purely that I know of a pure fiscal effect on interest rates are pretty small. So it would take quite a bit more deterioration to overcome the exorbitant privilege, but not impossible. But then you have to add on top of that what the tariff war is doing, and whether the tariff fight right now actually raises concerns about foreign investors about how they would be treated, which is a different issue than the fiscal issue. It's about whether, if we're willing to put tariffs on foreign countries, would we be willing to treat foreign investors differently? And in fact, we know that the incoming chair of the Council of Economic Advisors has a paper in which he talks about perhaps forcing some countries to hold U.S. Treasury bonds at a reduced rate, at a penalty rate, which is not something you've heard American policymakers say much in the past. So, you know, you could understand why foreign investors might be afraid.
Yeah, that's what we have as part of the so-called Mar-a-Lago Accord proposal, right?
Yeah.
Now, Tam, I mean, you've kind of dealt in your career with international economics for many, many years, and the question, of course, is if the U.S. Doesn't really offer safe assets and doesn't enjoy or wouldn't enjoy the exorbitant privilege anymore, who would? Will there be still a safe asset in the world, or will it be a multipolar system where really nobody knows exactly where to invest, or is it going to be a broad spread of portfolios? Are there any obvious alternatives to the US dollar as an investment vehicle?
Well, let me start by reminding you that there are two elements to exorbitant privilege. One, which I think is potentially quite volatile, is this funding advantage. I'll come back to that in a second. But the other that I mentioned was the sheer size of US markets. Now, that's not going away anytime soon. You know, you're not going to suddenly have the US stock market become a quarter of its size. Admittedly, in the world, it may go down as the dollar goes down, but you know, even in 2010, when the dollar was a lot lower than it is today, US made up 40% of global bonds. Now it's more like 60% because of the dollar. But you know, the US would still be a very large presence and therefore would attract incoming money from the rest of the world. The safe asset thing, though, is rather different, and there is an element of everybody agreeing what is a safe asset. And I'll give you the classic example of this, which is gold. So every time there's something uncertain happening in the world, everybody moves into gold and the gold price goes up. And we've seen that recently. But there is no particular reason why it should be gold. It could be lots of different assets, but everybody thinks, oh, there's something uncertain going on, let's get into gold, and therefore it's a self-fulfilling prophecy. You can think about that to some extent with US treasuries, and so you could imagine that going away. What would take its place? That's an interesting question. There's probably nothing of the same size and liquidity, but obviously there's German bonds, there's French bonds, there's Japanese bonds. There are many other types of bonds from advanced countries where the rule of law is relatively well defined, which could take up some of the slack in terms of the safe assets. But there'd probably be a smaller pool, so there'd be less to choose from. So that one can imagine changing quite fast. As I say, the difference is that the US also seems to have this relatively unparalleled ability to turn its physical assets in the economy into marketable bonds. And that's something which is pretty specific to a few economies. To some extent, Australia, the UK, Canada, sort of what we call Anglo-Saxon countries often have this. But bank-based financial systems really don't have that kind of characteristic, and therefore much of Western Europe or Japan would not have that. So I think that funding those kind of inflows will probably continue. But if you don't have the funding advantage, that's just storing up problems for the future, because you'll end up more indebted if you get those inflows.
Okay, we have to slowly come to a close, but Joe, any?
Sure. Well, I have, on this issue of what could replace the dollar, it seems to me, speaking here at the International Monetary Fund meetings, I have always thought that if the IMF could get the support of its main countries to do so, it would make a lot of sense to try to move the world towards a more symmetric system where the SDR played a bigger role. And the way to do that, it seems to me, is to create synthetic SDRs from medium-term government bonds of the members, especially the members of the SDR, but that could be expanded to any country with sound macro policy. And then with the support of the IMF, if the US and other countries agreed, this might be a more symmetric, even larger market, because it would be the size of the US Treasury market plus the size of the Bunds and the Japanese JGBs and of course now the Chinese bond market, which raises some issues. But it would be sort of more of a global standard. So, but it would take the IMF and its members to make this happen, because it's not going to happen without official support.
Sure.
But it could be a different standard that could even be used for invoicing and settlement if countries wanted it to. Anyway.
Going back all the way to Keynes's Bancorp proposal.
Maybe,
Yeah.
yes. Well, the Articles of Agreement say that the SDR should be the primary reserve currency, and this would be one way to make it happen.
Can I give you one last thought about what's going on now? We've ended up, if the reciprocal tariffs don't happen and all of that, we've ended up with a 10% tariff with a bit more on China. It's very people have talked about the Louvre and Plaza Accords, but it's actually much, much more reminiscent of the Nixon shock of 1971, when again, Nixon imposed a 10% tariff. Okay, didn't have a high one on China, but he did do something which was really fundamental to the system, which was he stopped the convertibility of dollars into gold. So sort of two very fundamental actions, a 10% tariff and an end of convertibility. Now we've got a 10% tariff and even more on China. So on some level, it's not as different from the Nixon shock, which again happened at a time when the US decided that the international monetary system was not working for them. So it's just a thought for people who are interested in going down the historical
history. Yes. Well, thank you both. We're at the end of our discussion. We're looking forward to the paper about the sustainability of the US current account deficit appearing at the Peterson Institute, hopefully soon. And please stay tuned. We're here all week for discussions about what's going on at the World Bank IMF spring meetings, and we soon have a discussion about kind of what to expect from these meetings. So stay with us, and thank you very much.